You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. My name is Mark Benzaquen, and joining me once again in the studio today is my colleague, Roma Colwell, a 25-year options veteran with roles ranging from market maker and risk manager, among others, and now, lucky for us, a fellow options instructor here at OIC. Roma, welcome back.
Thanks, Mark. Happy to be here.
Roma, as you know, one of the aspects of options that traders find attractive is their use as a potential income stream through the selling of calls and puts. And of course, we know that selling options is not without its risks. So to that end, and seeing as how you'll be talking about the potential risks and rewards of selling options in your two upcoming OIC webinars, I thought maybe we could explore some of those risks and rewards in today's session. How does that sound?
That sounds absolutely perfect.
Okay, great. Let's start with defining by what we mean by generating income, because we're not talking about bringing home a steady paycheck, of course. Income from options is an entirely different animal, right?
Right, exactly. So for many in this industry, generating income is often used for strategies that actually produce a credit that goes into your account. Now, this a lot of times applies to selling options, because when you sell an option, you collect that premium, and that premium is yours to keep throughout the course of the life of that option.
Right, and that premium represents, in a sense, you could look at it that premium represents a risk for the seller, because that seller is going to be saddled with the obligation to deliver stock or buy stock, depending on if it's a call or put. Mm-hmm. So in return for that obligation, they're going to demand some compensation for it. That's the premium.
That's the premium that they're collecting.
So when we're talking about generating income, we're talking about collecting premium from selling options.
Mm-hmm.
Okay. So collecting premium from selling options, that's going to involve assignment risk, which I want to get into just a second here. So when we talk about selling strategies, the first one that comes to mind for me is what I would consider likely one of the most widely used strategies, and that's covered calls. What can you tell us about that?
Yeah, a covered call is useful. And that, a lot of times you might have stock that's not producing or not really going in the direction you want it to go in, or it's just sitting there. And it's sitting there not creating any kind of return or income. And one of the ways to offset that is by selling a covered call. Now, of course, when you sell a covered call, you are obligated to sell your stock. So the risk in there, there's a couple of risks, but the risk is that you might have to sell your stock. On the other hand, you're getting that premium. So if you never get assigned on it, you collect that premium. Further, when you're selecting your strike that you're using, one way to look at that is where are you willing to sell that stock. Mm-hmm. And of course, if you want to sell the stock higher than where it's trading, the premium that you're going to collect is less. But if you want to sell it kind of closer to where it's trading, then the premium you collect is more. And that's kind of the give and take on what you need to look at when you're determining what strike and how much premium you want to take. Now, in all of these, in the covered call strategy, that premium that you collect effectively lowers the price of your original purchase price. Now, this does not eliminate the risk of the stock going to zero.
Right.
Right. It just offsets it just a little bit by whatever income you've or premium you've collected.
Right. So the risk with the covered call is still that long stock because theoretically the stock could go to zero. But what you're saying is, while it may not necessarily be a risk, but it certainly is an aspect inherent to the strategy in that you're selling options, therefore you're going to have that potential risk of being assigned. You would sell the stock that you have with this covered call. Mm-hmm. That strike price that you have, we can kind of think of that as the exit price. Mm-hmm. Where am I comfortable selling these shares? If I bought these shares for $50, do I want to sell them at 52? Do I want to sell them at 55? Do I want to sell them at 60? That dollar amount is going to be my exit price. That strike price will be the exit price. But you're also saying that the higher I go from 52 to 55 to 60, let's say, the higher I go, the less premium obviously I'm going to get because right. From the option buyer's perspective, why would I want to get myself into a contract where I'm agreeing to buy stock for $60 a share when it's currently trading $50 in the market? I may be willing to do that, but I'm not going to be willing to put a lot of money behind that premium-wise. So the farther we go out of the money, less premium we collect. For the seller, that could be considered or viewed as maybe a negative because they're collecting less premium. However, they're increasing that eventual, or I should say potential exit price if they get assigned.
Right. So we're looking at the probability, right? Okay. So the probably for all of those that, look at deltas, right? So the probability, you can look at a delta at that probability. So then if you're looking at the 55 strike, going back to your example, that 55 strike could be a 30 delta, which, says to anyone that has a 30% chance of being in the money. Mm-hmm. Where if we went further out to the 60 delta, so $5 higher, that strike.
The 60 strike, right?
The 60 strike, right? The delta on that could be 10, right? So we're talking 10% chance. And of course, that probability is correlated to the price of that premium that's built into that option.
Okay, excellent. So let's do this. Let's look at a variation of the covered call. We know that the standard setup is you're long 100 shares of stock. and you sell one call against it. But if those 100 shares of stock can end up costing a great deal of money, right? Let's say, look back at what is a way that investors can maybe utilize a covered call strategy, but reduce that upfront capital requirement from buying 100 shares of stock.
Yeah, so that's a leap, right? These leap options, they go out depending on when you're looking at this strategy, but they could go out a year to 2 years. So if you buy a leap, of course you're paying a smaller dollar outlet than you would the underlying, right?
Right.
Depending on which strike you select, that correlation between the underlying could be higher than something that is further out of the money. If I want it to mimic the underlying, then I'm going to buy, getting back to the delta, I'm going to be buying an option with a higher delta.
Okay.
So I have less money that I've had to put into the trade, but I'm controlling almost the equivalent of that underlying. So I can then look at selling that call, right? That's really kind of closer to expiration than that leap is. So I can sell that option, collect the premium on it, and then as time goes on and we get closer, I can continue to do this again and again for the less capital. Now, there is a downside with doing a leap, and that is you don't get the dividend. So you need to, if you're trading a stock that has a dividend, that's going to be your trade-off.
Right. So with the leap, you're buying a in the money, and typically it's a deep in the money. I would expect, as you were mentioning, you want a closer correlation between the option moving along with the stock. So maybe buying a deep in the money leap, and then selling those shorter term calls against it, and then depending on what happens with that short call, if you get assigned, now you've got to deliver stock. So what happens because you don't own the stock?
Yeah, now that's one of the risks that comes along with it. Now, you certainly could exercise your leap. Now, whether that is economical, because you have paid some premium for that leap. The other side of that is you may be required to buy the stock. So as a trader, it's so important that you're looking at these positions and you're managing them for the future. So if I'm holding that short call that's either in the money or, about to be in the money, then I might look at using, rolling it or getting out of that trade. But there's all kinds of strategies to kind of continue the position and manage the risk that goes along with that, because that's a huge risk. The risk really is in part, in terms of dollars, is established, but it could be that your clearing firm may not allow you to be short that particular stock. I mean, there's all kinds of reasons why you can't be short a stock. Part of it is, the whole mechanism of borrowing.
And you bring up a good point when you talk about managing. Options trading is unlike stock in the sense that it's, an options investor is an active investor, right? It's somebody looking at their position on a daily basis, sometimes several times a day. Whereas with stock, a lot of times it might be a set it and forget it. You buy the stock, you throw it in a drawer, and you really don't even look at it again. But options, you need to, as I mentioned, you need to monitor, you need to be an active participant. Definitely a good point that you made. So thank you for that. Let's shift gears. We just talked about calls, short calls, whether it be with the covered call or the in the money leap with the short call. And that's a strategy commonly known as the poor man's covered call, which makes sense because you're not, it doesn't involve as much money up front. All right, now let's shift gears to puts, specifically cash secured puts. As we're selling options, we're generating income. But with a cash secured put, income isn't really the primary objective of that, is it?
No, not really.
Okay. Fair.
Typically, the primary objective is to be able to purchase the stock, lower than where it's actually trading.
Right.
Right.
At a discount.
At a discount, right? Some people really kind of look at selling, these puts, these cash secured puts, as a way to collect premium to buy it lower, right? And they will say, the put buyer is actually, giving me money so that I can buy it lower. And if it never gets there, then I keep that premium. Again, and what we mentioned earlier is that premium is your premium, regardless of whether it's assigned or not.
Right. And the idea, so when we're selling puts, we are, we talked earlier about the obligation. A put seller has the obligation to buy stock. So if stock is trading, say, $50, and I sell a 45 strike put, let's say, I am obligated to buy shares, to buy stock at $45 a share, $5 below where it's currently trading, if I get assigned. And let's say I sell that put for $2. So now, if I did get assigned, if shares did drop, I buy the stock for $45 a share, but I got paid $2 up front to do it. So I'm really buying stock for $43. When the trade was enacted, stock was trading $50. So I'm buying it at a significant discount. That's kind of the idea with the cash secured put. The problem, the way I see it, is twofold. Number one, if stock prices never dip, right? The idea is I'm looking to buy it below where it currently is in the market. If those shares continue to increase, I just missed out on, a potential trade.
Right.
The other risk that I want to talk about is, what if shares don't just dip, but they plummet? They go from 50 to 45 to 40 to 35, et cetera. Where does that leave me?
Right. And, that is the risk you would take even if you own the stock.
Yeah,
right?
Good point.
And you're going to, if the stock goes down and it goes down dramatically, you're short a put, you're going to lose money.
You're going to wear those shares.
Right. But of course, you're buying it at 43 to use your example versus buying it at 50. So you have that $7 cushion in. And we should get back into the reason why they're called a cash secured, right? When you sell a put, these clearing firms are going to actually have you put up the risk in that trade. So if you're selling that 45 put for $2, you're actually going to have to put up the 4,300 for those 100 shares. So that is the secure part of it. They're going to require you to put up the other side. So in terms of risk, if it goes to zero, that's your risk, is the amount of money that you put up. And now, there are certainly, for both things that you just mentioned, there are strategies out there. So you mentioned one, if the stock goes up to 50, if it goes, just goes up, the only thing you did was collect the premium. But there are ways to protect yourself if it does really crazy, move up, where you could actually buy a call, so that if it does go up and you really want that stock, then, you buy the call and whatever you sold that put for might offset it. I mean, we're getting into other strategies, but that is something that you can do. In terms of risk, if it goes down, the flip side of that is that you can buy a put lower than that 45 strike. So if you actually do get assigned and you want that kind of protection, then you buy the 40 put, and you're paying, you might be paying 50 cents for it or $1. You're still collecting your premium. But if you are, buying at 45, you've collected the $2. So you effectively bought the stock at 43. You bought this put at 40. you've got a $3 loss there, plus whatever you paid for that put, which is significantly less than what you sold the other put for.
Okay.
I hope that's not too confusing.
Yeah, no, it's a departure from obviously selling options, but I like the idea that you're saying that even if things go, again, it's back to managing the position.
Right.
Even if things don't go your way with, for example, this cash secured puts, there are ways you can manage the position, whether you're making money on it, whether you're losing money on it, what have you. Again, being that active participant is what options trading is all about. So in reality, for both the covered call and the cash secured put, that strike selection is either going to be where the investor exits their stock position or enters into a new one, both resulting from assignment. So not only should the investor be comfortable and willing to buy or sell stock at that strike price, they can maybe see assignment as a glistening badge of success in that the trade performed exactly as they designed it to. Wouldn't you agree with that?
I would agree with that. And I know, like, when you're trading a cash secured put, the whole idea is, in part that you get assigned on the stock, right? That's part of the goal.
Right.
On the other side is when you're selling a covered call, for many investors, they don't want to be assigned on that call. Now, if they don't, there are a couple of ways to mitigate that. So one is strike selection. Now, with strike selection, the higher strike you go, the less premium you're going to collect. But yet, the odds of being assigned and you having to sell your stock is less. So you've got to, as an investor, you have to figure out what that balance is. Now, of course, if you are assigned on the higher strike, you collect, that's a profit there, right? Between where you bought it and where you're assigned, that strike that you've selected, plus the premium. So it's not necessarily a bad thing, but for some investors, that stock, holding that stock is important to them.
Right. And though the concept of assignment is inherent to covered call writing, that doesn't mean that the covered call writer is either automatically going to be assigned. Obviously, the stock has to get to a certain point. But if the writer feels in jeopardy of assignment, whether you had mentioned earlier dividends or even if it's just the simple fact that the stock price is increasing, if they kind of change their mind that they don't want to sell stock now at $55, now that prices are creeping up. And you had mentioned position management, maybe rolling it up to a higher strike, more time, what have you. But perhaps the most simple thing to do is to just turn around and close out that position. You cannot be assigned unless you have an assignable position, right? So at or actually prior to expiration, you may see a lot of option sellers turning around and becoming option buyers to close out those positions to avoid assignment. Is that right?
That is right. And while you were saying that, it dawned on me another side of if somebody is assigned on the put and now they're long stock, something that I didn't mention is the cycle, right? So if you're long stock, you can start by selling, we're doing a covered call again.
Right.
And that is pretty common that we see this cycle where they buy stock by selling that put, then they turn around, they do the covered call. And when they're signed on the covered call,
they do a cash secured put
right.
and rinse and I call it the rinse and repeat strategy. I think it's more well known as maybe the wheel strategy, but yeah, it's definitely a cycle of selling, and potentially generating an income stream. Excellent point. Thank you for bringing that up. And again, great information as always. Roma, thank you so much for joining me again today. Really appreciate this. And thank you to all of our listeners and supporters out there. Before we sign off, I want to invite you to register for Roma's 2 upcoming OIC webinars, which will take a closer look at various strategies designed to generate income, including a deeper dive into the concepts that we discussed today. You can register on OIC's website, www.optionseducation.org, to attend the live presentation or to view it on demand. And as always, please feel free to send us your questions via email at options@theocc.com or live chat with us on our website. Thanks again to all those listening, and we'll be talking with you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.